Welcome to Video 1E. In this video, we're going to cover three primary learning objectives. Number one, we're going to describe the concept of incidence of attacks. Number two, we're going to define and provide examples of an implicit tax. And number three, we're going to use a handy shortcut to calculate after-tax returns. This is a video for which you may want to have your calculator handy, so you can perform some of the calculations as you watch. As always, the slides are also posted in Blackboard. Okay, let's get started. This pretest has two questions. We start this video with a story of two hotels and a hotel or occupancy tax. Hotel taxes are very popular in tourist areas. And so in this example, we are going to look at hotel taxes in Florida. The state of Florida has a hotel tax, but also allows counties to assess a separate and additional tax. Because Disney World in Orlando is such a popular destination, it should come as no surprise that counties near Disney impose a hotel tax. Near Orlando are two counties that impose differing hotel taxes. Osceola County charges a 13% tax, and Lake County charges an 11% tax. In our hypothetical example, these two hotels, although in different counties, are identical in every other way, and both charge $100 per room per night. After considering the hotel tax, Osceola County's hotel will cost $113, and the Lake County hotel would cost $111. Imagine something that looks like this, with the two hotels adjacent to one another, but straddling the county line. Since these two hotels are identical in every way, what hotel will tourists select? Well, over time, more and more tourists will select the cheaper alternative in Lake County and save the $2 each night. As the Osceola Hotel watches its paying guests flock to the other hotel, it will have no choice but to lower its price for the room. In fact, in order to charge the same $111 including tax, Osceola will charge only $98.23, thus reducing the profit on the room by $1.77. Now, we need to pause for a moment and consider, who is the taxpayer? Well, that's still the hotel. They pay the tax. But who is bearing the burden? Because Hotel 1 and Hotel 2 are perfect substitutes for one another, part of the burden of that tax is going to be shifted to the Osceola Hotel because they'll be unable to shift the burden of that tax onto the guest, and therefore they'll retain that burden. Understanding who bears the incidence of a tax is critical to understanding tax policy in general. Congratulations. You've been named CFO of a company. And one of your first tasks is to hire an extremely capable student from SDSU's accounting program. You've identified the ideal candidate, and you have determined that her work, skill, and experience are valued at about $50,000 a year. You're preparing her offer letter and considering her compensation package, which you know will include her salary, the cost of her health care, as your company provides health care, and you also know that, as we covered in an earlier video, your company will also be required to pay 7.65% of her salary in employment taxes. You recognize that as a result, your compensation package needs to be $50,000. Since healthcare costs the company about $5,000 per year for this employee, and you know that taxes are 7.65%, you can use a little algebra to calculate her new salary as $41,802. Based on this scenario, who bears the burden of the employer's share of the employment taxes? Is it the employer who actually pays both the company's share and the withholding from the employee, or is it the employee? Research shows that in almost all cases, it is the employee that bears the burden of both forms of the tax. Let's change gears a bit. You are now the treasurer for the city of San Diego. You are certainly making the most of your accounting degree. The city is considering issuing some bonds to pay for a new soccer stadium in San Diego. The city generally makes good on its debts, but all the same, investors want a certain amount of return for the privilege of allowing the city to use their money for a number of years, and that return is commonly known as interest. At the same time, across town, Qualcomm is also looking to issue bonds, and in what could only be described as an amazing coincidence, investors perceive the risk of the city of San Diego to be identical to that of Qualcomm, and thus would demand the exact same return on bonds issued by either party. As is often the case, private industry is a bit faster to the market and offers their bonds at 7%. A $10,000 bond at 7% pays $700 of interest a year. Of course, the investors are required to pay income taxes on that return of 25% or $175. That leaves Qualcomm's bond investors with an after-tax return of $525 or 5.25%. Since you know investors are expecting the same return from San Diego bonds, you consider pricing them at the same 7% as Qualcomm did. However, as a graduate of the SDSU accounting program, you know that bonds issued by state and local governments are tax exempt. That is to say, the investors do not pay any income tax on the interest. As a result, you pause for a moment and realize, well, why should the city pay 7% interest when the investors will receive a higher after-tax rate of return than necessary? Investors expect and will certainly purchase a San Diego bond that pays only 5.25%, because the after-tax return is what really matters. As a result, you offer the bonds at 5.25% and save the city heaps of money. You're thinking of running for mayor next year. The indirect tax that the San Diego bondholders paid is known as an implicit tax. That is the reduced before-tax return that a tax-favored asset produces because of its tax-advantaged status. That can be contrasted with the explicit tax paid by the Qualcomm bondholders. The municipal bond market in the United States operates exactly like we have described it here, with lower interest rates for state and local bonds. In our last segment of this video, we are going to consider the relationship between pre-tax and after-tax a bit more. To do so, we are going back in time to our algebra class. Let's start with the relationship we already understand, that pre-tax minus tax equals after-tax. I hope you're saying to yourself, this is so simple. No wonder I'm going to be mayor of San Diego. We also know from our previous discussion of the basic tax formula that tax equals pre-tax times the tax rate. Thus, we can do a little substitution, and pre-tax minus pre-tax times the tax rate equals after-tax. Okay, ready? Here's the algebra. If we factor a pre-tax out of the previous equation, we get pre-tax times 1 minus the tax rate equals after-tax. If we do a little reorganization, after-tax equals pre-tax times 1 minus the tax rate. Let's keep this simple equation in mind as we consider Maria, who is debating between two bond investments, a tax-exempt bond at 6% and a taxable bond at 8%. And Maria has a 25% marginal tax rate. We can start by calculating her return on the taxable bond. The $100,000 times 8% is $8,000 of pre-tax income. At a 25% tax rate, that is taxes of $2,000, leaving $6,000 or 6% after tax. We can also use the shortcut method of 8% times 1 minus the tax rate of 25%, which also results in 6%. The tax-exempt bond should be more straightforward. Pre-tax and after-tax return of $6,000 or 6%. The shortcut method can apply equally here. Now we can ask ourselves, what is the explicit tax Maria pays? On the taxable bond, she pays an explicit tax of $2,000. On the tax-exempt bond, she pays no explicit tax at all. If we assume matching risk and terms between the two bonds, then she pays an implicit tax of 2% on the tax-exempt bond and no implicit tax on the taxable bond at all. In either case, her after-tax return is 6%. That brings us to the end of video 1E on implicit taxes.